Okay, welcome to the Rand Swiss Under the Microscope, which is where we take a specific product and we put it under a microscope. Today we're looking at our latest structured product. The idea is protect capital, maximize return. And we're going to go through a couple of things. I'm joined by Govender, portfolio manager at Rand Swiss as well, the better portfolio manager at the moment with the AI portfolio, which I'm very jealous
to qualify
of.
at the moment.
I'm very jealous, but I'm also a very happy investor. It's very mixed emotions at the moment because I'm very happy with the returns, but it's very sad I'm not beating Viv. But so on the agenda today, we are going to first just discuss, because we had a look at the guest list today. A lot of new people maybe don't understand how structured products work. So we're just going to go through the basics of what is a structured product, how do we construct them, when to use them, how to use them. We'll go through the basic mechanics of the Autocall that we've created for this month. We're going to do a market overview, just put it in the context of where we see markets, and I said, just try and understand, like, how should you be reacting to markets now and whether or not this type of strategy would be appropriate to you. We've got a little bit of back testing, and then there are some important considerations around structured products like credit risk. I want to take you through that. Then we've got some payoff scenarios. So pretty simple presentation today, I hope. We're going to try and make out a complex instrument simple. But yeah, before we start, just so that you understand who we are, we kind of run our business through three different divisions, if you will. So, traditionally we're known for securities broking. That's where we've won many awards over the years. And I suppose this is kind of like where we started in the structured products. So, I mean, we were kind of dealing with the instruments that actually comprise the structured products. And then, this structured products for us fall into our managed solutions. So it's products that we've created internally. And there's all sorts of advantages to that for our client base. And of course, we've got the wealth and advisory business as well, which is more holistic planning that looks at you specifically. And instead of you watching webinars and trying to work out exactly if a product is appropriate, you will have a wealth manager that looks at your entire balance sheet and can actually recommend whether or not the product is suitable. For now, this is certainly in the managed solution segment. So we're going to take you through all the features of the product, all the risks of the product, as much of the mechanics of the product as you can. It is a webinar, so we do encourage you to use the Q&A box, hit us in chat. We're going to try and answer all your questions. Like I said, we're going to try and make it simple, but these are complex products, so I'm sure there will be quite a few questions. As I said, long history of kind of like being ranked #1 securities broker. Very happy that the addition at the moment is that we are now also South Africa's top boutique wealth manager, which I'm kind of really happy with what's happening in our wealth division. But Viv, you want to take us through it? Structured products, we always start these with a quote. So Viv, your quote: the first rule of investment is don't lose money. The second rule of investment is don't forget the first rule. And that's all the rules there are.
Yeah. And this is important to understand, is that if you can basically not lose money when things are bad, you don't need that much upside to look really good over the longer term. And this is the kind of strategy that we want to basically get you for some of your money. Okay. And so, okay, can we proceed? Oh yeah, sorry. Yeah. Okay. So what is a structured product? Okay. A structured product is a type of instrument that combines various underlying financial instruments, usually some kind of bond and a derivative or multiple derivatives, to create a specific outcome based on market conditions. It's a custom built instrument. And the main goals usually is to protect your capital, enhance returns, or a combination of the two of these. Now, the way I would normally phrase it is this. If you look at it like investing in like Facebook was designed as an investment for Mark Zuckerberg and for the Facebook employees and the initial people that basically created the company. It wasn't designed for the people that are buying Facebook shares. Okay, so when Mark Zuckerberg goes on a spree about buying or creating the metaverse or whatever, it's more about the investment serving his needs as opposed to serving the general public's needs. And that's what most shares are like. They were not designed primarily as investments. They only came to the market and only offer themselves as investments to serve the needs of the founders. However, a structured product is something that was created with the investor in mind first. So it's like, for instance, a cave is something you just find in the wild. And yes, it might suit your needs, it might give you shelter, but it probably doesn't suit your needs exactly. Whereas a house was designed, you want so many bedrooms because you have this many kids, you want this many bathrooms, etc., etc. A structured product was designed specifically for the needs of a investor. And so therefore, in some cases, you don't want to have massive upside if it means that you're taking a lot of risk. So you might say, I want to reduce my risk and give up a little bit of upside for that. Sometimes you say to yourself, I don't want to have the possibility of certain negative things happening to my investment. And for that, I will take this level of protection. And by that, I'll also constrain the outcomes that I'm being exposed to on the upside. Or you may even say, I want to profit rather from this particular set of circumstances where it's the ratio of gold per silver, or the ratio of this stock to the index, or this particular interest rate investment, which there might be not a single instrument out there that gives you the exact payment profile that you want for that outcome. That's where a structured product comes into play. A structured product is something that's designed with you as the investor in mind, as opposed to just something designed with somebody else's incentives in mind. Okay. So to understand what the basic structured product looks like, it's usually in two parts, a bond and a derivative. Now, there's different kinds of structured products out there, but I'm talking about the ones that we mainly use, just the more mainstream ones. The thing with structured products is like a house. You can have a normal kind of house, or you can have something weird that's like 20 stories high and has a nuclear power plant in the basement. Though there's different kinds of stuff. But the basic structured products that you're going to be encountering have two parts to it. One is a bond. A bond is basically, like a government bond or a bank bond usually. And the other one is a derivative, an option of some kind. Why do you have these two parts? Well, the bond gives you the protection. So you say to yourself, I don't want to take a risk beyond a certain point. That's where the bond comes in. It guarantees like a certain amount of protection. The derivative, on the other hand, is what gives you that upside. That gives you that, for instance, in some cases, that geared upside. Okay. But there's also ways in which derivatives and options work where instead of buying an option, you could sell one, in which case you receive the premium instead of basically paying it. And in that case, you have different ways in which you can basically give up certain kind of like advantages to gain certain other advantages. So often you'll find, for instance, when you have a derivative that normally would give you unlimited upside, you could cap that upside and say, I will take everything up to like 40%, and beyond 40%, I won't take any more upside. For giving up that advantage, you get a bit of extra funding, and you take that funding and you can go to your protection side and says, okay, I want a little extra protection for this portfolio so that if things go down, I know that I'm protected in certain circumstances. And that's the kind of thing we're talking about here. Now, why use structured products? Well, there's different ways. I mean, why use a house? Why use any kind of structure? Okay, why use something you build? Well, there's different needs to it, but for most investors, it's going to be the following. Capital protection in volatile times. So when you are a little concerned about the market, you want to have some protection, and that's what a structured product can provide for you. You're not going to have any protection with a Facebook share or an Alphabet share or whatever, but you can get protection with a structured product. Enhanced returns. Sometimes you say to yourself, I want to get a lot of upside, even with a small amount of market improvement. That's where a structured product can give you that kind of market-related returns. Like, for instance, you can say, if the stock market is up only 1%, I don't want to just have a 1% upside. It's too low for me. I want to have like an 8% upside. I'll give up the possibility that the market goes up 15%. I won't get that 15% upside, but I want to make sure if the market's positive, I want to have at least that 8% or 12% upside. And this is what a structured product can give you. It can give you these enhanced returns in certain range-bound markets. Next, access to markets you would not normally invest in. And that's another aspect of structured products. You can make structured products out of anything. There are certain kinds of markets out there. There's certain kind of instruments that you might want to invest in. For instance, I mentioned to you before, there's instruments like, for instance, the ratio of gold to silver. There's instruments like interest rate levels, etc. That is not going to be quite as easy to invest in as they would be via a structured product. And finally, tailored strategies for specific goals. So you may say to yourself, I have this specific goal in mind. I want to have a certain outcome because I'm retiring, or I want to basically have certain life goals I want to meet. You can create a structure that will achieve those goals for you within certain limitations. And remember, the structure, there's always a trade-off. This is not money for nothing. If you want to have more protection, you give up some of the upside. You want more upside, you give away some of your protection. But it's always a balance. And I would say to you that the chances are that the majority of people out there want the same exact investment profile and payoff as the share market gives to you is quite unlikely. Okay, most people don't want the unlimited upside without any protection. They want some protection, and they're willing to give a bit of upside for that, at least for certain parts of their investments. And that comes to the next part. Okay. So the way I like to phrase it for people is this: you have different kinds of pots of money in your mind. There's bread money and there's lobster money. Okay, bread money is taking care of your basic needs, making sure that certain obligations, etc., are cared for no matter what happens. Lobster money is when the market goes crazy. It's like buying Bitcoin at like R1 a share, or R1 a coin, or something like that, share, or buying Alphabet, or buying Google, or buying Naspers back in the day. It's that massive upside, and everybody wants the lobster money, but you don't want to risk your bread for your lobster, if you know what I mean. You want to have a certain portion of your funds invested into things that have a capital protection element to it, that are going to protect you if there is a bit of a downturn. Now, the thing with the market right now is, and you've seen it since about 2008, and I'm a bit older, you can see the gray in my beard. You can see, like, I've been around for a bit of time, and so I remember times before 2008, and most people don't. I mean, if you've been in 2008, that's almost 20 years. So someone's like, say, 40 years old, from 20 till now, they basically, all they've seen is that post-2008 market. And that market only looks like it's going up, right? But we've seen times in the past where there have been downturns, significant downturns. And if you are in one of those periods, you don't want to be having obligations come to you. You don't want to have, a period of, we'll show you in a second, of 13 years in which the stock market did nothing for you, okay? You want to have a certain, a basic outcome that you are more than happy to, like, or not have, that you're willing to be satisfied with, giving up some of that potential massive upside. Because again, you want to take care of the bread, even though you want to have a portion for the lobster. Okay.
Yeah, so I think bread and lobster money, and I suppose it applies across the board as well. So so this is just the basic terms on the Autocall that we've created, and we kind of run through the markets, the market view, kind of in relation to why we've selected this. So while Viv was right, I mean, we are also pricing a gold note at the moment because people are very excited about gold, and there's a way to say, wait a minute, I've got a call with one of the banks after this presentation, where we're actually going to, we're looking for 100% capital protection on the gold miners, but we're going to take only partial upside on any future run. So you can essentially, if gold does go to, say, $10,000, $20,000 an ounce, you're not going to get the full participation on the upside, but you take no risk to do that. So you can kind of capture the momentum without risk. So it's something that we're looking at. But today, these are the terms that we've chosen. So we've linked to the S&P 500 Nikkei and Euro stocks. So this is part of a product roll. So we had a product that looked very similar to this. I believe it was in the NASDAQ, and we might still switch that S&P out for NASDAQ, depending on the ultimate pricing when we strike. But essentially, it will be one of the two US indices. And I suppose the reason that we really select these, and I'll show you a slide a little bit later, is that these are, established developed markets that are quite correlated, which is fairly important. The structured product, it has a maximum duration of 5 years. So that means, like, the money you should, when you make an investment like this, think about it in the same way as you would think about an equity-based investment. This is designed to service a longer term client. This is not something that, if you're saying, I need to save up because I'm planning on buying a house in a year, or I'm thinking of, like, I've got education that I've got to fund in 2 years, even though, we do a delay, and this one has a delay of 12 months before the first observation. Even though most of the time these come out in probably 1.5, 2 years and allow you to reinvest and compound, you need to go into it with a mindset that this is a 5-year product, because you have a 5-year period in which this has time to work. It has 30% capital protection. So what does that mean? It means that if you look at the S&P 500, the Nikkei, and the Euro stocks, this is essentially looking at the index that is lagging the most. As long as that after 5 years is down less than 30%, you have capital protection. You get all your money back. So let's say in this world of these three correlated indices that we go through a period of the next 5 years and the market just ends 28% down. You get all your money back. And that's quite an important feature to the product, which we're going to show you now, because that also gives you the opportunity then to go and reinvest in the market at much, much lower levels. If it's beyond 30%, when I say, okay, just to explain that more deeper, if it's beyond 30%, it will behave exactly like the ETF. So if you went and invested in S&P 500 and S&P 500 falls 40% over 5 years, you'll be down 40%. The same with this product. If you invest, and we've selected the 30% level for very specific reasons, which we'll show you now. We do have structured products that give you 100% capital protection as well. It does, to get that 100% capital protection, you do give away a lot of the upside coupon, as we were saying. So the coupon that we're marketing here is at 12%. So that's a 12% US dollar coupon. This is a US dollar note. And just to also put that in context, that's what, 2.5, almost 3% above the S&P's long run average. So this is a slightly more aggressive note. It's not a 100% capital protected note. If you were to do capital protection, your coupon would probably be sitting at about 7.5 to 8%, depending if it's a dollar or pound or which currency that we're denominating it in. But yeah, that's where you'd be sitting with 100% capital protection. And we're saying, looking at the correlation, looking at the indices, there's a very high chance that you'll get this kind of enhanced return. And it really is what we want. And then it's got, so like I said, we delay the observations for 12 months, but then you have 9 chances to win, if you want to put it that way. So from the 12th month, we're going to do an observation. If all 3 of those indices are just positive, they can be 1% positive each, you get 12%. If after the first observation, one of those indices is negative, it just rolls to the next observation. And those happen every 6 months for 5 years. And at any point over that 5-year period, all you need is the worst of those 3 indices to be 1% positive. The product will cash out and you'll get essentially a 12% simple interest coupon. So it'll be 12 plus 12 plus 12 plus 12, or it'll actually be 12 plus 6 plus 6 plus 6 for every half year. So that's essentially the features of the product, and we're going to drill into the product deeper now. But I think the whole point now is to try and put this in the context of why have we selected it, and I suppose where markets are going. So market overview, Viv, where do we see markets now? I did a global equity presentation last night, and I was super bearish, and I kind of talked some smack about AI as well. I'm going to be honest, not really, but I just said this is a blistering rally. Markets do look very, very high at the moment. At the same time, I mean, these were headlines drawn from essentially yesterday's papers. I also get the sense that if it's in the press, it's in the price, and it's very seldom, if you look at the history of bubbles, and everyone is calling bubble. I mean, we've got Bloomberg. AI has carried the stock market, and concerns of are mounting of a bubble. A lot of people talking about. Generally, when the bubble is about to burst, nobody's talking about a bubble. So it does seem like it's early days, but I mean, you've got Jamie Dimon coming out and saying that he thinks that there's going to be a stock market correction. There's I think a lot of uncertainty in markets at the moment. We don't know how long this can run for, but it could collapse in a heap. So I mean, your take on the markets at the moment. I mean, I gave a full review of this last night. So where do you see markets now?
It's a weird combination. So firstly, we have a market that's at all-time highs, locally and internationally as well. In the US, for instance, 80% of all the gains year to date in the stock market have been on AI-related stocks. 40% of US GDP growth has been AI-related, and maybe even more than that if you just consider all the knock-on effects. In South Africa, half of our growth has been explained by basically a handful of precious metal stocks, the Anglos and so on, Anglo Golds and even to a certain extent some of the platinum stocks as well. And this is a very narrow base on which to build, all-time highs. That's one way. The second way to look at this is that we are, with regards to AI, quite likely, I'm not saying guaranteed, but quite likely, it looks quite likely that we are in the midst of maybe the greatest technological revolution of our lifetimes, maybe the greatest one since the Industrial Revolution. Some people even say the greatest one since the invention of fire. Okay, what does it mean? That means that we could be seeing unprecedented levels of GDP growth in the next 5 to 10 years. We're talking global growth rates of 5, 10%, maybe even higher per annum. Okay. And in fact, if you look at the way these guys are investing in the stock market at the moment, for instance, the amount of money that Microsoft is putting into the market requires trillions of dollars of global GDP growth to justify that. There is a ratio. So let's just say, for instance, look at Microsoft. Microsoft, to basically get $1 million of value, sorry, of revenue, of money coming into it, would need to probably generate somewhere in the region of $20+ million of benefit for the world. That's been the normal ratio, at least 20 times, maybe even close to 50 times. If Microsoft's going to put $100 billion into AI, it needs 20 to 50 times that in terms of global GDP growth for it to take its little share of revenue. 20 to 50 times 100 billion is $2 to $5 trillion. The global GDP is around about $100 trillion. So we're talking about Microsoft's investment, that 1 year investment into AI of 100 billion should generate, or needs to generate, somewhere between 2 to 5% of global GDP growth to justify itself. That's a lot of growth. But if AI turns out to be a real phenomena, as these guys are betting on, that is achievable. Okay, so that's the dilemma. Next with gold. Gold past $4,000 an ounce. Of course, this is a huge jump up. It was closer to 3,300 a few months ago. It's a massive return. But why is gold going up? It's not going up just because of speculation. It's going up because of a number of fundamental factors. Number one, we are seeing the weakening of the dollar because of both geopolitical reasons, but also because of what the Trump administration is doing to the dollar. We're seeing fears around the independence of the Reserve Bank of the US, which is the Federal Reserve. The Federal Reserve protects the value of the dollar. Without the Federal Reserve, the dollar gets weaker. People look to other things. And then there's also the fact that people are moving away from the US dollar towards something as an alternative because of the Trump's administration's dealings with the rest of the world. The Chinese don't want to have as much dollar reserves. They want more gold and other kind of things. And then finally, there's a longer-term technical fundamental reason. It's this. The demographic crisis we are approaching at the moment means that there's more old people than there are people that are working age. Those old people have requirements, liabilities, things that are owed to them by the government because of pension requirements, et cetera, et cetera. The government is supposed to get taxes from the young and pay to the old. There's fewer young, there's more old. The government's books don't balance, okay? And those things mean that generally, historically, it translates into deflating your currency, because that's one way to get out of your debt, is to have a weaker currency. And that's where gold becomes much more attractive. So we have gold all-time highs, very, very risky. At the same time, real fundamental reasons why it's here and why it's likely to continue going forward. If you're in this environment and you have all-time highs, but you have real reasons why you want to invest, you want something like this structure. It's going to give you protection on the downside in case these all-time highs are going to be pulled back, but still upside participation at levels that are historically above what the market gives you, so that you don't miss out entirely on what may be the greatest bull run in your lifetime.
Right. And yeah, so I mean, if we look at it as well, I think what's also important to understand when we construct structured products, and before I kind of talk to this chart, when you're constructing structured products, like Viv was saying, there's a bond inside there and there's an option as well. So there's a couple of things that play into the way that you structure it. So the one is obviously where interest rates are at the moment. Now we are seeing interest rates starting to be cut. South Africa has been a little bit more resilient. Unfortunately, the Reserve Bank didn't give us the 25 basis points I was looking for. But we've seen the first cut from the Fed this year. The market is pricing in 2 more cuts in the October meeting and the December meeting. And I think the idea is that there's definitely been a shift in the Fed's view towards the labor market over, the inflation picture, even though the inflation is running a little bit hotter. In that environment, where we are going to see, let's say, a decrease in interest rates, the bond component of the structured product requires the higher interest rate to generate the coupon. So you are almost buying into a bond at a level where the coupon is slightly higher. If interest rates start to fall, you get a natural uplift in your mark to market, because I can tell you, if the Fed cuts the interest rates by, let's say, another 1% over the next year and a half, when we go to price the same Autocall as we're pricing now, we're not getting 12%. We're probably getting somewhere around, depending on also volatility, there's a lot of inputs to it, but you could be looking at 9.5%, 10% instead. I mean, that's how different it can be. So that's also one of the opportunities, is that interest rates are moderately elevated at this stage. And then volatility is, of course, pricing into the options. So the bond, prices off the rates, but the volatility, is a key component to pricing options as well. And I mean, the one easy way to think about it is like, when you're buying a put or when you kind of trading options, or you can kind of think of it like insurance. And, the best time to buy insurance is really when there's nothing is wrong. I mean, one of the guys who work with an investor, he always uses the barn example. He says, if you go to the insurance company and you say, I'd like to insure my barn, and the barn hasn't burnt down for 20 years, they're going to give you a pretty low premium to do that. The barn burnt down yesterday, and then you come back, you've just rebuilt it, you say, I want insurance, that premium's a lot higher. So, where we're sitting at the moment, and you can see it in this chart, I mean, markets have been pretty sanguine over this period of time. We've had the crashes, we've had the corrections, but because inflation has been very low, and because the Fed's focus has been on inflation, or at least because inflation hasn't been a problem, they've been able to respond by quickly dropping interest rates, flooding the system with money, which has kind of inflated asset prices. And that's why we saw, we've got COVID up there, we've got Ukraine, Russia kind of scenario that we saw in 2022. We've got the Liberation Day sell-off. That's these three sell-offs. So you can see this is less than a year, 2.5 years plus, let's call it 1 year. And the market was back to where, general market levels were back to where they are, and the run just kept on going. But that's really not true over the history of markets. And if you look at it, I mean, a lot of guys are comparing the environment that we're in now to kind of the dot-com crisis, which is what we're looking at on the far left there. If you had invested at the peak of the market there, and I mean, at that stage, everything looked, I mean, fiber optics were going to change the world as well. Everything was looking fantastic. Got a trading system jumping up there. So fiber optics are looking great. This was going to change the world, and it really did. It really did. But before that, we saw, a massive correction in overpriced stocks. Now, whether, like Viv says, like AI for me looks real. And I mean, I'm invested in the AI portfolio. I think that there is still legs to go in this, but there's the bread money and there's the lobster money, and there's a certain component of your portfolio that if I mean, clients, I think always they expect you like, I want to allocate 100% of my portfolio to the best possible investment. That's kind of how a lot of retail clients think. That's a terrible way to make investments. It's against all diversification principles. What you want to do is you want to structure your portfolio so that you've got a component of your money that if you do get the supernormal growth, you participate in it. Invest in the AI portfolio, invest in stocks, have your element there. But you want that kind of bread money as well, that if it goes wrong, you've got something to counterbalance that, and that isn't going to lose you money over time, and that will give you an opportunity to invest in lower levels. And you can see here, so this is the dot-com. I mean, we took 6.5 years to then recover. You're talking 5.5 years plus, five plus years after the global financial crisis. And part of this has been central banks responding quickly. Maybe it's also that there's just the flow of information is that much faster these days. I don't think so, but I mean, that's also possible. Why are we getting faster recoveries? But for me, there's no guarantee that just because we're getting faster recoveries these days, that means it's always going to be the case. There's a very real possibility that at some point the market crashes and stays down for a significant period. In that environment, how would you like to invest? And I think, we actually had a client literally in 2022. And there's, I suppose, two ways to think about this. I'm going to use this example a bit later on as well. But we had a client in 2022 was looking at the market and decided, listen, he also thought, the run looks very similar. There was a crash, there was a recovery, the recovery extended, and then we went through a big dip. Now we've had a crash, a recovery, the recovery is extended. Does that mean we're going into a big dip? We don't know. It could run further. There's a huge level of uncertainty in predicting the future markets. If you come to watch our presentations and you're hoping for us to tell you exactly what market pricing is going to do, we wouldn't be doing presentations if we knew that. But what we do know is how to use instruments to correctly protect ourselves against that. Now, came to us in 2022, invested in the product. Over the same period, and I mean, I've actually got the three indices. I've got a more detailed example later that I'm going to go through. But after 2.5 years, immediately he was negative on the product. And, there was kind of like, oh, what have I done? No, but at least you had invested in something with this fixed simple interest coupon that is going to give you kind of an above market average return as long as everything returns positive. After, I think it was on the third, so it was one, two, three, fourth, the fourth or fifth observation, cash positive, and he literally got his simple interest return in a market that if you had gone into the market, invested in S&P 500, Nikkei, Euro stocks, and you'd said, there's my cash, I'm just going to sit, after 2.5 years, you'd return zilch. And I mean, that in the modern world feels like a long time. Now imagine that was 6.5 years. But for him, that was invested in this product. He literally got a simple interest coupon. It had, I mean, I think, I can't remember exactly, but I think it came out to about a 36% dollar-based return over a period where the market was flat. Massive underperformance with also having the certainty that he had that capital protection at 30%. In this one, it was absolutely perfect. There wasn't ever a time where it even breached that capital protection barrier because the fall was only 26%. But even if it had breached, remember that capital protection is at the expiry of the product. You can go down 70%. It's not a knockout barrier. You go 70% through the barrier. As long as the markets recover to within that 30% bound, you're good. You get all your money back. So yeah, so let's have a look at, yeah, so this is, I suppose this is where we are now. I'm just going to chat a little bit about the back. I mean, anything you want to add, Viv, to the kind of historic payoffs?
Yeah. Also, I mean, the thing is that, we've had a long run from 2008, basically till now. It's basically been a one-way, trip. I mean, there's been a couple pullbacks, but generally we've had a trend to the market. But if you had to look at, for instance, the previous period from about 2000 to 2013, if you had invested in 2000 in this market, you have to wait 13 years before you started to see, any kind of real positivity to your investment. You'd have been fat for effectively for a decade and a half almost. Now, there's many periods in history where this has happened. I mean, there was the Roaring Twenties followed by the Great Depression. You know what I mean? There's been these prolonged periods of times where the market has done either very well or done, particularly badly for a long period of time. I'm not saying that the next, say, 10 years is going to be a Great Depression. I'm not saying it's going to be the Roaring Twenties. I'm just saying is that because we don't know, have a bit of money that acts or will act better in certain circumstances. And if you think that there's a possibility we might have a bit prolonged, flattish period, this might be an investment to get into.
And I think it's another point that I know is not going to be made later as well. So even if the product, let's say that you do kick in the capital protection and the index is down, a lot of clients look at that as a negative event. Maybe it comes from kind of almost being a relative performance portfolio. We look at relative performance more than anything else. We had, I mean, how many structured products have we launched, Viv? I mean, we're talking
dozens,
more than dozens. I mean, it's got to be close to like 40, 50 over the last, probably more than 50 products. We've literally had one product ever. Two products ever that have not returned a positive return, that have returned capital to shareholders. The one of them, it was actually, I think it was an Investec product, was the emerging markets basket. And I mean, it was literally at the peak that it was invested in. China, just fell apart completely, dragged the whole emerging market basket down. And the product finished, I think it was like 18, 19% negative. The point is that a client at that stage, they look at it and go, oh, well, it didn't generate me a positive return. But what they can do, if that was part of a well-constructed portfolio that was allocated to their emerging market exposure, they could then they got all their money back. So they actually had an 18% outperformance of an index, if they had gone and bought into, a general emerging markets ETF. Immediately take those funds and you deployed it into the emerging markets ETF. So you took your 18% relative outperformance and you deployed it into markets. Chinese markets then ran very hard. It was just the timing was slightly off, ran very hard, and the performance would have enhanced dramatically. Like it would have been so much better to have bought the structure and then used the capital protection kick out to reinvest in markets than to have bought into the emerging market index and just ridden through the volatility. So yeah, I think also that's one of the things that capital protection is actually key. And even if you are going through a longer period like this, to have, if the market's 40% down and you can have all your money back rather than be invested in equities where you get absolutely slammed. It's that Warren Buffett first rule: don't lose money, because like you now have an opportunity to deploy into far cheaper stocks. I mean, I felt that we've been through a lot of crashes now. My biggest regret in COVID, all these crashes recently. What are you sitting there going, oh, why didn't I invest more? The problem is a lot of times, like you knew you needed to be buying, but you were looking at it and it was like, I had no
Yeah.
not enough dry powder. So this also supplies that kind of like dry powder for you, which is exceptionally nice.
Yeah. And just an example I'm going to give you here. Look at this thing, 2000, right? Let's just say you had bought into here. By the time you get to about, say, 2000 and say 5 years later, this market's down, but it's not down so far that you'd be outside our protection level. And so what would happen? You would have still the 2000 level here. You would have lost no money for 5 years, but now you're buying cheaper. Let's do it again. Go forward, the period of time you came to this period like 5 years later. Again, market is basically down, but not so much down that you'd basically be whatever. And you can if you were here, you'd been like in a positive, and you would actually be like up massively. If you're down, actually no, for this one here, it was down for this many years. You'd have bought out here. You'd have actually gotten a return here. You'd have a return there. You'd have a return there. Over here, you basically have the same exact situation where you suddenly had these 3-4 years return. The market falls. You are ending down after 5 years. But now the money is still the same, and you can buy in again. And then look up, 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 up. And then over this period of time, you'd have had no losing years, and you would have had multiple up years. And so you would be significantly better off after 13 years as you just invest in the market directly.
Yeah, absolutely. And I think that's the thing. It's not just about like, this is my I'm too scared to lose it money. This is also, like I said, like we've made this quite opportunistic in that it does return above the average, the long run average of the market. So this is still a performance product. This is not the boring family vehicle. It is still like it's still a product designed to generate superior returns. Now, just in the caveat, I'm going to go through the back testing in a second. This is where we are at the moment. And I think one of the important considerations that you should understand about the product as well is because you've got the 3 indices, what we are looking for here is correlation as well. And often a question we get asked is, why did you select these 3 indices specifically? Why did you ask for S&P 500, Euro Stoxx Japan? And you can kind of see it here. The correlation between these 3 developed market indices is quite high. And one of the plays of a worst off triple index autocall, which this is you want the markets to be correlated. The worst thing that can happen for us is that all of these 3 major developed market indices, one just decides to behave totally differently to the rest. That's a risk. And it's one of the reasons that we don't, because a lot of people say, why don't you include China in this? Because this is one of our perpetual products. And I mean, the gold here is the Nikkei. And I mean, we've been very optimistic on Nikkei, because remember, I've said it to guys all the way through. How do we play Nikkei? We don't particularly want to go and invest directly in Japanese stocks. But what we think is that the yen is going to weaken. That's going to force up the Japanese stock market in yen terms, and then we'll take the dollar-based return. Thank you very much. And it's exactly what's played out. And I mean, you can see the Nikkei has been flat for many years, but I mean, there's been a fundamental change in the monetary policy in Japan. And I mean, this thing is, now going gangbusters, which is
but not in rand terms.
Not in rand terms, and not even in, I suppose, not even in dollar. Dollar terms has done fairly well. Yeah. I mean, it hasn't done as well. It's done slightly better than MSCI World, not as well as S&P 500. But yeah, so the idea is here we're just playing correlation, and now I'm just going to take you through a little bit of back testing as well. So this is just back testing running back. So here, instead of kind of like the anecdotal back testing that we showed you earlier, this is like a formal back test where we run basically every iteration. So we ran 1,500 iterations. So you're basically moving the 5-year window backwards, and you're running the product, and you're doing essentially like a simulation that says, I'm getting into the product today, what would have happened? I'm getting into the product, like a week later, what would have happened? I'm getting into the product a week later, what would have happened? And this is kind of like the probabilities that you end up with. So, these are observations. So like I said, we delay for the first 12 months. So we don't look at it, and then we look at it 18 months, 24 months, and so these are your 9 chances to win. So what this spits out is actually the probability historically looking back. I can't remember how far we did this one, to be honest, but this is looking back. I think this does go through 2008. So I mean, we're talking, at least well over a decade. Many, many
I
simulations.
think 2015, 16.
Was it 2016?
Yeah.
Okay. But essentially, like you based on that, you do actually expect this product 52% of the time to call in the first 12 months. So like there's a high degree, it's like almost a coin toss that you will be out in 12 months. So we did this, like I said, the reason for this product at the moment as well, like one of the reasons is we've just had a product expire. A year ago, we did a product like this. We've got all the capital there. Now, all of those investors are saying, thank you very much. They actually got a 14% dollar-based return. Interest rates were a little bit higher at that stage. Now they're saying, what happens next? So what we're doing is we're rolling them out of that product directly into this product. So you leave that product to go this. And now, like we're saying, by doing that, you're compounding, you're resetting your protection levels. Everything is resetting for you in this scenario. And the probability is that in a year's time we'll be resetting it again. If you go through it, there's then an additional 14% chance it'll be out in 18 months, and it goes through all the probabilities down there. So the probability of it not cashing in 5 years is about, call it just under 3%. So there's a 97% chance that this card, based on historical back testing, this product will cash positively. This is not like a red or black bet. It's like there's a 97% chance based on historic data that you're going to get a positive 12% coupon, which is above. And when I say that or better, I never explained it earlier. When we come to strike, we're going to push the banks that we use for better terms. So we're marketing at 12%. Any benefit we get on strike, we pass on to you. So even last year's one that ended up at a 14% coupon, we were marketing it at 12. We managed to get 14%. In the COVID crash, we got up to 15.5 on one note there. But like indicative pricing is probably about 12.3 at the moment. But who knows? We're going to strike this on the 22nd of October. So if we'll see where markets are at that stage. But we obviously try and push for the highest coupon possible. But probability is this is going to cash out. In the 3% of times, what happened? 3% of times, one of the three indices was negative over the 5-year period, in which case all your capital was returned. At no point over the backtesting period did it actually breach the capital protection and lose money. And that's, in the last, I think you said is 10 years. So I think it's over a 10-year backtest. I'll just confirm.
1,500.
Yeah, okay. So, so that's it. Now, obviously, it's a US dollar product as well. So, like this is held at an offshore custodian entirely. I'm going to go through the terms in a bit. I did this also last night. So this is just our currency forecast at the moment. When I say currency, it's not our forecast, it's every currency forecast that's available on the LSA platform. And you can see, one of the things I always point to clients is kind of the range that we're trading in at the moment. So like kind of lowest estimate on the rand dollar exchange rate is kind of 16.50. Yesterday we were at 17.09. I think we're back to 17.20 at the moment. So if you are looking at this product in rand terms, it does seem like a decent time to exit, in my opinion. I mean, the rand is quite a lot stronger, and definitely, looking at forecasts in terms of rand dollar, I would expect to see a dollar rebound. Maybe not an aggressive. I don't think, I'm certainly not fear mongering saying that we're going to 20 rand to the dollar in the short term, but at 17.20, it looks like a pretty good exit level. For me, I mean, obviously, is that downtrend? I'd probably say we'll see a thing, but over the next 5 years, I mean, trends change over time as well. But currently, I don't think it's a bad level to kind of buy your dollars either. So some important considerations about this. So like I said, we just talked about it. This is a US dollar product. The minimum deposit on the product is $20,000. The closing date will be 22nd of October. So I'm probably going to strike on the Friday, but applications have to close on the 22nd because we've got Nikkei as one of the underlying indices. I've got to almost book that the day before, just because of the trading hours in Japan. So it's going to be a hard close. I know quite often, guys watch these videos and then they send us the orders on the 21st, but we still got to get custody accounts. Guys, if applications aren't in by the 22nd, this is a tranche product. It will close. You will not get into it. As much as I would love you to get into it, and we always try and bend the rules at the last minute, please, if you are interested, send orders early. because we won't guarantee that we're going to be able to get you in if it's post the 22nd October close. In terms of how do you buy this? So like I said, it's a new issue. So we issue a new ISIN number with the bank. Yeah, I mean, it's quite a process in the back end to kind of create the product, but we go through all of that. It's a brand new product. It's got an ISIN code. You can go look at it on a Bloomberg or a Reuters. You can go and pull it all up. And then you need a custodian account. So all of our custodians that we work with hold it. So whether you have a Velocity account, a DMA account with us, a Swiss Quote account with us, it can slot into any of those different accounts. So it can be in your normal stockbroking portfolio with us. And of course, all fees are included. Generally, there's about a 3, so I didn't actually put the fees up here. I always forget that, which is bad, but it's on the brochure and the application form. We do a 3% structuring fee for this, which is probably half the price of what everyone else in the market charges, and it's much lower than our model portfolios. So it's, I mean, if you look at it over
a 5-year period.
Yeah, over a 5-year period, yeah. Yeah, we generally also we only use A-rated investment banks for these types of offshore products. We have got kind of some local banks for some local kind of specific structures that we do like, but in this case, this will be an A-rated investment bank. So that means Citigroup, Morgan Stanley, BNP Paribas, Barclays. It's going to be one of those as the investment paper. So what does that mean? It means that you are taking on the credit risk of that bank. They are the bank that's making a product. So while there's the bond hedge and the option hedge underneath it, this is a promise by that bank. So you've got to be happy with that bank's credit risk. Yeah, to put it in context, and I mean, I don't want to pick on any South African bank here, but you look at Barclays. I mean, the S&P rating is A+, A1 at Moody's, A+ at Fitch. That's Barclays. Very possible we'll do this at Barclays. Goldman Sachs, okay, it's got a BB+. I mean, we don't have a lot of Goldman Sachs paper at the moment. We generally go with, I mean, we get best pricing kind of at Barclays. We've got a couple of City notes as well. It just depends. But if you compare that, I don't want to pick on any of the South African banks on here, but I mean, cast your eye over it. Go and look at some of the South African banks. All our South African banks, they take their credit rating from the sovereign. So in South Africa is sub-investment grade. You should be getting way higher terms from South African banks because South African banks are absolutely more risky than these. So yeah, it is, and remember this would have to wipe out Citigroup, or it'd have to wipe out Barclays for your product to be in trouble. Because they would have to default on their debt, which means Barclays share price goes to zero. It's a pretty scary world if that's the case. So we don't see the credit risk as material. I mean, because we're almost, you always say, but we're overprotecting on the credit side. We probably would be quite happy to go with a South African bank, but we're skewing on the side of safety here, almost at the cost of a little bit of the upside performance. But yeah, pretty safe. Anything else we need to say on credit risk?
Just one more thing. With the credit risk, I mean, we are extremely cautious about this. We don't do multiple or too many of our products with any particular bank, and we just spread it out among them. So if you do these structures, we don't want you to do one structure only. We'd want you to do multiple structures over time, so you get different levels and different credit risk behind it. So you wouldn't be concerned about, say, Citigroup going bankrupt alone, but you'd say part in Citigroup, part in BBA, part in, say, Barclays, whatever. And that is, still spreading out your risk a bit more. But as Gary said, I mean, according to the people that understand risk, every single one of the banks we are looking at is significantly, not just slightly, significantly better than a South African government bond. Right. So that's just to give you an idea of just how cautious we are. And even then, we don't put everything in one basket.
Yeah. And I think that's important. And I mean, often, if you are working with a Rand Swiss portfolio manager and you have built up a portfolio of these kinds of structured products, it's one of the things that they'll go through you within your review. They actually do a credit risk analysis each time, saying, okay, you've got a little bit of Barclays paper, you've got this. So they actually look at the different credit products that you have. But yeah, think about it as it's a position in your portfolio, like anything else. It's just a safer position than having a stock, because you're in the debt world rather than the credit world. Payoff scenarios. So we've got a couple of payoff scenarios. I think I've explained it more or less, but if you want to take us through the situation.
Just to give you an understanding how this works, right? Imagine a soccer match where every 10 minutes the referee blows the whistle and says, what's the score? And if your team is winning, they stop the match, and you get basically as much points as basically the time has passed, effectively. So let's just say after half the match is over, your team is up for the first time, match is stopped, you get half a point. That's kind of how these things work. So let's just look at the first observation. So the first observation happens after 12 months. So it's been 1 year gone through. If all three of these instruments are positive, so the Nikkei, the S&P, or the Nasdaq, which would be, and the European one, are all positive, even if it's 0.01%, 1 point up for each of them. What happens? We close the game down, we give you money back. It's been 1 year, so it's giving you basically 12% for that 1 year. And if it's not the case, let's just say one of them is down, okay? We do the next period. Again, all three positive, we stop the match, give you money back. But because you've had 1.5 years, it's 1.5 times 12, which is 18. Carry on. Every single 6-month period, we do the same thing. And if at any one of those 6-month periods, your three are positive, even if it's 1 point, not even 1%, 0.01% or what it may be at that point. Just look at 1 point positive, shut down, money back, and then 6% for every 6 months you've been invested, okay? At the end of the period, after 5 years, if at no 6-month period after the first year have all three been positive, okay, then we go and look at the various indices. And if all those indices are less than 30% down, we'll give you money back. If I have one of the indices is down to 31% or 32%, we'll give you the return on that index. So it's down, say 35%, we'll give you your money back minus that 35% fall in the worst index. Now, the thing is that it sounds like, this is a case where it's, too good to be true. But what we've done here is we've kind of, firstly, as Gary mentioned, we've looked at indices that correlate. Okay, they've correlated highly over the last few years. Why? Well, quite frankly, interest rate policy moves together at the moment, and therefore indices have tended to move together, number one. Number two, we basically have looked at the biggest indices in the world. So we're talking about the European, the Japanese, and the American. We've left out the Chinese because they're a bit uncorrelated, and they also have a bit more risk, than some of the other indices because of certain, interesting characteristics between them and the rest of the world, as well as their internal structure. So the chance of you having like a weird event happening, a black swan event happening to one of these indices that's not going to affect the others, also quite small. But that being said, there is a possibility that one of them does underperform significantly, and that could be the one thing that you'd say is a little bit more risk. Next thing to point out here is this: 12% per year is, like Gary said, a couple percent above what you normally accept as a average return for the US index, or historically, and which is one of the better performing indices. It outperforms, for instance, the European index of the longer term. You're doing a 10 to 12% return on average across your portfolio in US dollars. That is a very, very good return over a prolonged period of time. And so if you have multiple of these things here, usually giving you a 10 to 12% return, plus not losing your money when the market is down, that is going to usually perform as well or better than most of the other investments you have, while giving you a much smoother pathway in terms of how your investments perform over time. Okay?
Yeah. So yeah, just to try and make this, you need to kind of sit with a diagram for a bit, and it's in the brochures, just to kind of understand, run through all the iterations. But just to kind of explain it. So this is back to the client that literally did invest in 2022, bought at the highs in 22. What practically happened? And this is exactly what happened. So if you look at it, like I said, like literally bought into the product, and from there the markets just started heading south in a big way. And we went through a full 12-month period into the 3rd of January. So it was end of 2022, end of 3rd of January, and the first observation. So these were the three indices. You can see the green, red, and blue, which I think was S&P. I mean, we generally use these three because of the correlation. So let's just call them green, red, and blue, though. So green, red, and blue, all were negative. So what happened is he didn't lose money. If he had been in these three ETFs, he would have been negative, but he wasn't. So we looked at there, everything is negative, so it just rolls to the next observation. So this was the next observation 6 months later. 6 months later, we had seen index green was positive. So index green had recovered, but index red looks like it had actually just recovered a little bit, but index blue was the laggard at that stage. So it rolled to the third period. Index green kept on kind of moving up, but index red by this period and index blue, all three of them above the zero line, product cashes out. And like I said, like over that period to there, I mean, the return, I remember doing the comparison at that stage. I should probably put it up. But I mean, the return was minimal. It wasn't kind of massively different at that stage. But he got kind of like a significant upside in the coupon. So I see we've also got stacks of questions and all tax questions and stuff like that. So I want to get to them. So these are basically like, we are going to share the presentation afterwards, but these are the different, so there's only really 4 different payoff scenarios that you can have, which is, this is the worst case scenario where one index stops being correlated and really just bombs out and falls more than 30%. And then you adopt the risk of that index. The second case is the best case scenario, which is actually the one that it immediately cashes, the 52% scenario. So the case that happens 52% of the time based on the back testing. It's the one you want. Why do you want it to cash out every year? Because then we can compound. We roll into the next index, and now we reset levels, everything resets, and you kind of reset your term of 5 years as well. So you've got a full 5 years. So you've almost eliminated the risk for that 12 months, and now you've reset your 5 years. You don't only have 4 years to go or 3 years to go. You've got a full, it's almost like you've reset, you've got 9 lives, like a cat. And you know, when you reset it, you still got 9 lives. You know, when you roll it, you've only got 8 left, 7 left, 6 left. So that's how you got to think about it. So this is the best case scenario. The safe case, which is, okay, like one index does fall apart for whatever reason, but it finishes within the payment band. Then you get all your money back, which is fine. And then the final observation, which is like kind of like the weird one where one index thinks, but it just pokes its head up in the last scenario, and then you'll get the plus, 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 plus all the way through. So on to the Q&A, and I can see we've got a lot. So that's why I'm kind of going to think. So so first one, a question from Anonymous. How would you see a structured product with regard to managing tax and CGT when the money growth, when upside money growth needs to be managed in a portfolio?
Okay. So look, these structures, when they close, and therefore you have a capital gain event. There are structures we do have that don't give you this capital gain event, in which you can basically roll without a capital gain event occurring. I know people are, obviously having, income issues here, because if they do have, capital gain events while they're earning other funds, there could be a higher, rate of return. I have, quite frankly, not been too concerned about it. As long as it's capital gains, I'm happy with it. And these things have been treated as capital gains historically by by the tax man. The reason being is this: if you look at the forecast for South Africa's financial situation, it doesn't look positive going forward. So you can expect in the future capital gains to be higher than they are right now. They are probably not going to be lower. I would think if you had a bet, are capital gains in 20 years' time or 10 years' time going to be higher than they are at the moment? Is the 18% going to be the cap? I would say 18% is probably going to be the lower end of what is the expectations are for the next 10 to 20 years.
Yeah, I think it's a good point. So there's a couple of things, and like Phil says, like we do it both ways, and I mean we are looking at doing kind of like a wrapped note as well, but you've also got to look at it as a trade-off between fees and tax as well. So with these ones, these are unwrapped, and I mean because this kind of also I mean the next question I think is also on tax, so maybe this will answer it, but generally, the rule that's applied at SARS, and when SARS thinks about products like this, it comes down to, was capital at risk? So quite often you'll see with structured products, the guys will structure them with a 95% capital protection rather than 100% capital protection. Because when you have the 100% capital protection, it starts to look too much like a bond and not enough like an equity. And when that's the case, you can, so when that's the case, suddenly you're sitting in a scenario where SARS is looking at it going, oh, this should fall to the income account, not the capital account. So you'll see a lot of them put the 95%. So the first test is capital at risk. The second test is the intention to invest for more than 3.5 years. Like I said, these are 5-year notes. So the intention is clearly a longer term investment. And I know from practical experience, well, I'm not going to do a tax directive for you on it. I mean, I would advise going to a tax practitioner and getting a tax directive on it. But I can tell you, practically speaking, everyone that I speak to in the industry Everyone that we've practically worked with using structured products over the last 10 years, as long as you're not using one that spits out a coupon so that the coupon is snowballing and that it's not looking like you're getting paid an interest return on it, as long as there's capital at risk and as long as your intention was to invest for more than 5 years. So if you're doing like a 1 year note, like, that's, I'm not saying it's definitely going to happen, but from what I've seen, it's always claimed as capital gains as well. Now, to the question around how do you manage the capital gains as well. So on the one hand, I mean, it's kind of like a deeper question around managing capital gains too. So, I mean, I know a lot of people look at it like, let's just defer capital gains as long as humanly possible. I mean, and that's great, well done. It's good, I suppose. Is it good? I mean, I'm not sure it is good because one, you get the 40,000 Rand exemption every year as well, which you're not using if you're just deferring everything. But eventually you are going to pay the tax. And mathematically, it actually works out the same, whether you pay capital gains all the way through, or you defer everything and pay your, let's say, 18% all at the end, or, and this only works in a marginal taxpayer scenario. But I mean, maybe we must do a tax webinar around this.
So that's that as well. I mean, think of this way, right? If you have say say 20 million rands of assets, right? You expect that to grow at about 10% a year. That basically means 2 million rands of growth every year coming through. You're going to be in that marginal highest tax bracket anyway.
Yeah, 100%. Yeah. But like the point is, I was just qualifying it with we're talking about a marginal taxpayer here. But the point is, you pay the capital gains tax early or later. Like if you're unstructured anyway, and if you're buying this in your personal name, like you're going to pay CGT, even if you manage to defer your capital gains tax until you die. Well, as you pass away, you sell everything into your estate anyway, and your heirs will pay the capital gains tax. So you're not going to avoid the capital gains tax. These are you can structure around the tax issue as well. So, I mean, these can go into offshore trusts. There's many, like they can go into, local trust and companies through asset swap as well. There's many ways to kind of mitigate that. One of the ways that we are exploring at the moment is to wrap the whole portfolio in an AMC, so an actively managed certificate. And there we will be able to defer the tax indefinitely. The problem is it's going to add to your costs as well. I mean, the investor structure, we are probably going to be looking at doing an investor structure. Like I said, I don't want to invest with local banks. We use local banks, but they've got a fairly nice structure coming out in November that we probably are we're still drilling into it, but I think we probably are. They wrap that within a company shell where you can defer indefinitely and then you can roll within the company. The problem is it adds a lot of cost to it as well. So, where you're saving on the tax, whether you save in to defer the tax now, you're paying extra cost to be able to do that. And ultimately, when you sell your share in that company, you're going to pay the same amount of CGT, whether you paid a little bit along the way anyway. If anything, you've just paid extra management fees on money that will eventually go to SARS.
And also you'll pay CGT in 2050's CGT rate, not in 2030's CGT rate.
100%.
Which I'm willing to bet you right now will be a higher CGT rate.
Yeah. So like I said, I mean, the tax structuring question is a great one. I mean, I can go into it in a lot of detail, but there's a lot of nuance to it as well, because it really depends on you and your tax situation. And I mean, kind of, it's probably a bigger conversation that I would encourage you to reach out to us. I'll happily sit in with one of our wealth managers and we'll take you through like the correct tax structuring around these notes. Because there's a lot of cool, like I said, there's a lot of cool things you can do with them. But yeah, I hope that answers the first question. Yeah. So we've got a lot of questions. Okay, I want to avoid interest income for tax purposes, of course. Is there a way, is there anything that you can recommend to take the current expected volatile market because of the expected problems in US markets into consideration, the amount to invest? Okay, cool. Over 3 to 5 years. Absolutely. Yeah. So like, I mean, again, this is a perfect example. Like this is like maybe saying like, can we tailor a note that is ex-US that, potentially, like I said, I think we've already addressed, like avoiding income tax. It's one of the reasons that we love these notes. So sorry, I get excited about it when I talk about tax. So remember, like in the South African market, like if you buying a fixed income product, right? So you're buying something that's going to give you a coupon, give you some nice stable return. If you're buying that discretionary, buying it in the name of a company or name in South Africa, it's going to be taxed at income tax rates. Even in a company, you're going to pay your 27% company tax. You ever want to get that in your personal name, you're paying dividend withholding tax at 20, you're out at 41.5 anyway. But, and if it's your personal name, it's going to be taxed at your marginal income tax rate. It sucks, right? So one of the things to do, and one of the products that we found particularly useful is products that behave in a way that it gives the security of a fixed income product that results in capital gains tax. And I can give you the name of a whole lot if you pop me an email afterwards. But I'll give you some basic examples now. So one, if you're going to just go and buy like bond funds, basically, what I'd say is you stick that in your pre-retirement products, because there nothing is taxed. Eventually, when you take it out, you'll take it out at an income tax rate. But we tend to look at the holistic view of a client's portfolio. Discretionary assets that sit outside the retirement space, everything must be capital in nature. Anything within the retirement space, if we're balancing the entire portfolio, we'll stack that with the income assets that generate tax. But outside here, there might be a requirement for lower risk products. Structured products are a perfect example. Like I said, as long as you tick the 3.5 years, some capital at risk, and snowball the coupon, you should be on the capital account. 100%, you'll be good. The other way of doing it is like if you are looking at an offshore account, like we work with a number of accumulating funds overseas. So we've got a great private credit fund that we use. They give kind of 7.5%. I mean, it fluctuates between probably 7.2, maybe 7, and probably 8.1. That's kind of like the range. It's a short duration private debt fund. They've been around since 2009. It's awesome. And they, even though it's kind of like private credit, so it is an alternative, I mean, they just give you that steady kind of 8%, you call it 7.5%, 8% in dollars. They've got a dollar class, pound class, euro class, and Aussie dollar class. And all of that is accumulating, so it rolls up. So it's capital in nature. So because it's an offshore fund and because we kind of using our Cat 2 license to do it, you can declare it as capital, capital in nature, which is awesome. Like I said, the structures work well. And then, all the accumulating funds that you buy overseas, because South Africa doesn't distinguish, like our tax law doesn't distinguish between an accumulating and a distributing fund in that way. As long as it's not paying out the interest, it actually goes onto the capital account, which is cool. And I've got that from, I think, 91 and Alan Gray and someone else that have confirmed that our thinking on this is 100%. So some cool stuff, but again, like that's a deeper discussion if you're trying to get things off that's more tax planning. And I'd rather say than dealing with the managed solutions guys, come speak to one of our wealth managers. Okay, great talk. What is the difference from an endowment, which has tax advantages? Okay, so these are all wealth questions. Okay.
Yeah. So,
okay, endowment. Yeah, you want to go through the
so
endowment?
the endowment gives you basically a 12% capital gains max tax rate versus if you were the highest marginal taxpayer, you get 18% capital gains tax rate, right? Now, the thing is that what is the difference? It's basically 18% of your growth versus 12% of your growth. Now, imagine you grew at 10%, okay, overall. What's 18% of 10%? It's 1.8. What's basically 12% of 10%? It's 1.2. What's the difference? 0.6%. If you look at what most endowments charge you, they charge you after VAT about 0.65%. That means you have to see the underlying thing grow at least basically 10+% to see that pretty big benefit coming through for the endowment.
Yeah, so we did a modeling scenario on this based on like kind of endowment, including all endowment pricing. Endowments are interesting in that, I mean, they're great. Like, listen, the estate planning benefits, all of that is great. And like, it's not just the tax benefits. Like, I mean, there's huge estate planning benefits to having endowment. The offshore endowments are far more liquid than the local endowments. Now, just to put this in context, these can be held in endowments as well. You can put a structured product with this structured product will be going into, some clients that we already are rolling for are holding this in offshore endowments. And I mean, we can do it through the Old Mutual IP Plus plan. We can do it through the Glacier Global Life plan. We work with the old Momentum offshore endowment option. There's lots of ones that we can put this into. So it's basically all the, I mean, I think 91 and Allen Gray, they've got quite strict product vetting, and they'll only put offshore funds because they don't allow for PSPs within the endowment structures. But I mean, we put it in endowments. Like I said, it's a very flexible. This is an underlying instrument. It's a building block for a whole portfolio. And if you do have questions around kind of like the endowment and the advantages within endowments, absolutely set up a meeting with one of our wealth managers. They'll sit with you. They'll go through the whole portfolio. They'll check whether the endowment is appropriate. But like I said, we did some modeling. I mean, we say like if you're probably going to die within 16 to 17 years, endowment is a fantastic product. It's a fantastic product. I mean, in terms of the estate duty, the executive fees at least, in terms of like kind of like the transmission of assets, it makes things a lot simpler. But the costs are prohibitive. Like, I mean, they're high. They're really high. And like I said, like most wealth management firms they're not gonna tell you that, because they end up sitting on a list platform where, whether they go with an endowment wrapper or whether they go with a flexible investment, their cost base is identical. We have a very wide suite of products. Our custodians are stockbroking custodians, so they're very cheap. Instead of going and paying 40 basis points at one of the LISPs, we can give you offshore, like offshore custody at 15. So suddenly you're looking at it and you're going, now I've got to pay 40 for my custody on list plus the endowment fee, where I can do this outside. So like I said, I mean, you've done a whole lot of modeling on this, it's about 2-3 weeks ago. And it comes out at about 16 years, but that's in our environment. That's within the Rand Swiss ecosystem when it becomes appropriate for clients. But nice question. Yeah, very, very nice question. Okay, what taxes apply? I think we covered that one. Okay, the 12% coupon, is this superior or to a fixed safe deposit investment? Okay.
US dollar returns.
Another very good question. So our new analyst, Sean Murison, and we have had a big debate about this. And when I say a debate about this, it was just something we were chatting about.
Yeah.
So remember, there is, like in my mind, there's a big difference between a 12% US dollar coupon and a 12% Rand coupon. As Sean accurately points out, it's made no difference, like that relationship hasn't held up over basically the last year, where the dollar has weakened and the Rand has gotten a lot stronger. I mean, then 12% is 12%, and except you've also got a kind of a 10% re-rating of the currency. It's like I'd much rather take a 12% Rand coupon and then also get the currency appreciation. But generally, if you look historically, I think since 1994, we've weakened on average at about 6%. Now it's a nuanced question as well, because that relationship could be changing now that the Reserve Bank is targeting a lower kind of the lower bound of our inflation targeting range. So if they firmly anchor inflation expectations at 3%, I don't think you're going to see the same pace of weakening over time. But there is a material difference between a dollar coupon and a Rand coupon if you look just at relative products as well. If you have to go into a South African government bond, what you're talking on 10-year, it's like almost 10%. If you have to go into a US Treasury, I mean, we're talking a 10-year at what? 4. Yeah. So we're talking 4%. So that's that's where you would see like when you're doing kind of like modeling and calculations, that becomes your risk-free rate. So to get a 12% dollar coupon, you're 8% above the risk-free rate. To get a 12% Rand coupon, you're only 4% above the risk-free rate. Or sorry, 2% of getting tired, 2% above the risk-free rate. So there is a big difference between dollars and Rand. But I do take Sean's point as well.
Also,
when the currency is strengthening from a client's perspective in the short term,
but also assuming a taxation level of like most people who have $20,000 to invest in one of these structures are probably paying the 40+% tax rate as a marginal tax rate. So let's just say you're paying the 45% tax rate. You make 12% in interest. You're going to pay basically 45% of that 12% away as taxes. I'm assuming that you've gone beyond the 23,800 tax-free limit or exemption limit. If you make basically the same 12% in terms of this coupon. Okay, it's not compounding, so it's simple. So there is a slight drop there, but you're getting 72% back. It's 82% back. So it's 100 minus 18, 82% back. So you're talking about 55% of the 12% versus 82% of the 12%. That's the difference between capital gains versus interest income.
Yeah. And I think that's important because the 12% coupon will most likely be capital in nature. So unless your accountant is terrible. How does the 3% fee affect the payout of the coupon? It doesn't at all. So everything that we've shown you today is after fees. So it's all inclusive. So the 3% is actually worked into that. So when we price with a structuring house, we price our fee. Like I said, like, I mean, you know, when I look at the menus of these things that go around to the different institutions, I mean, fees typically range from 3% is kind of the lowest fee on a structured product. I mean, I've seen them ranging up to like, I mean, on kind of like general menus that like financial planners use, I mean, they range up to about 8%. I think certain banks, when they're structuring, like if it's a more complex structuring requirement, can charge 9-10% on these kind of notes. So the 3% is free, but just remember the whole payoff is after fees. So that 12% coupon is net what you're going to receive in your account.
But also your guaranteed capital as well.
Yeah. And the guarantee, there's no, that 3% is worked into the structured product. So it's part of the distribution and you getting it after the fee. And generally, like I said, like if we can't like kind of hit our, you know, let's say the market, something happens to volatility, we also use that fee kind of as fat. So if we've got like a whole lot of client orders and we're going to everywhere and we push it every bank and going, guys, we need 12%. That's what we've marketed to clients. And they're like, we'll only give you 11.5. We'll drop we use that fee also to drop the 0.5%. We'll drop 0.5% off our fee to get the thing through at 12% coupon exactly. So it also allows us a little bit of fat because these are tranche products and we kind of talk to a whole lot of clients. We take a whole lot of subscriptions. You do this entire book build and then suddenly something happens in the market where you can't get your coupon. So that fee also does act as a little bit of a buffer for us. But like I said, we never increase the fee. Like our max fee is that 3%. Like, you know, a lot of houses also will go, okay, well, hey, we got great pricing, so now we're going to suddenly do a 4 or 5% fee, and the clients will still get what we market to do. We've always pushed through all the value back to the client, and as you can see historically, we normally market at 12. The guys coming out of the most recent one were at 14. The one that we got in kind of like the depths of the liberation sell-off, I mean, clients I think got 15.15% coupon there. So we just push the coupon straight through to you as a client, and that's a commitment that we have from our side as well. Can the input and output be in South African rand? So, okay, good question. In structured products, generally, yes. So the gold note that we're doing specifically now that I've got a pricing meeting for in a little bit, that will be probably a rand-based note. So we're going to issue it through a warrant program that will actually be listed and put into a JSE securities broking account. So that will be a fully local note. And that will have a rand payoff profile, and it just depends. It's because specifically that note, I want to kind of look at options and do structures around Harmony, Anglo Gold, and Goldfields as a basket, and we might use that as an equally weight basket. So we're still constructing the note and kind of like going backwards and forwards on pricing, but that will be a rand base. So this note that we talked about today, the note closing on the 22nd, that is a dollar price note. It's an offshore note fully. It does use exchange control allowances unless you're using an asset swap. So this is a fully offshore note.
But if you want to,
can you do rand? Of course you can do rand. Now, like I said, so obviously you do need to use your offshore allowances, but we do that whole process for you, like from, you know, literally we'll create you what we call like a investor cash management account, which is like kind of the hub to all the different accounts that we do for clients through our wealth management business. You literally pay your rand in there. We'll take care of the rest. We'll set up your offshore custodian. We'll do the transaction. The only thing is you need to still have limit available on your single discretionary allowance. If you don't, we probably do have time to still 12 days. Yeah, maybe not. Yeah, like I'd say, but like we can do a tax clearance for you. We do them free of charge. The last one I got through, I'm going to say 12 days is probably too little because the last one I think I got through, it was I think it was 7 working days, but there was public holidays in between. So, you know, like SARS, I think, reserves 21 days to get the 10 million rand allowances available. And it does take a little bit of time. But if we rush it, yeah, I don't think we'd make it by the 22nd. But yeah, we can always iterate a new note for you. And then we just use the 10 million rand allowance as well. It's really not as complicated as people think. Like I said, we get them through like 9 days. Yeah, as long as we get assets and liabilities, as long as your tax affairs are in order and you don't owe the receiver any money, and yeah, as long as we can kind of like determine the source of funds, which we do anyway on any account application. It's a pretty simple matter for us. So yeah, just let us know. And even if you have Rand, I mean, we can always externalize it. I mean, our rates on externalization are institutional as well. So you'll do a lot better with us externalizing it as part of the product rather than, trying to do it yourself through an independent bank. Is the return capital and income? Okay, I think we've answered this one. It is capital in nature. Remember, there's capital at risk because we haven't given you 100% capital protection. The intention is to invest for up to 5 years. So you could potentially be in for 5 years. Ticks both boxes at SARS. The coupon also snowballs, so it's not spitting out that 12% coupon. So it should go onto the capital account. Do you think the dollar will remain the world's go-to currency going forward? Ooh, another very, very good question.
Look, historically, currencies remain reserve currencies longer than you think. For instance, the pound was the reserve currency for the world after the UK was not the largest economy in the world, and after 2 world wars. It took 2 world wars and being like a really destroyed economy before the dollar really took over from the pound, in terms of replacing it. So unless we have a massive, catastrophic fall in the dollar in the next, say, few years, I was to say that the dollar would remain, even for instance, if China becomes the #1 country in the world in terms of GDP, it'll take more than that to have the dollar totally replaced as a go-to currency.
No, I tend to agree. So I mean, I think it also depends what happens in the next elections in the US as well. Like there's a lot of moving parts of that. So I mean, we can clearly see that central.
I don't think we'll have someone as bad for the dollar as Trump in the next election. But that's just like my. No one's going to be as bad as Trump for the next election.
Yeah, when you say bad as Trump, like in terms of
the dollar,
in terms of the dollar weakness, yeah. And also, like if you go and have a look at the dollar index chart over, let's say, the last, I don't know, however many years, the dollar, like I mean, the dollar might feel like we've had like a precipitous, like it might feel incredibly weak at the moment, because. I suppose of the rapid decline. It's the speed of the decline that has made it feel like things have really changed for the dollar. But I mean, the dollar index was at what, like 91, 90 a little while ago. What we had like 90, 96, 97 at the moment. So, I mean, there could be a long way to go. And this is still not going anywhere near like historic weakness for the dollar either compared to its 6 major trading partners. So, yes, the dollar is weakened. I mean, we were kind of arguing about, I think, at the beginning of the year as well. Like, I mean, we just had that kind of, Trump had come into power and everyone was like business friendly and the dollar had rocketed and we had like 110 on the dollar index. And I mean, we chatted about it. We said, like, I mean, a lot of this looks priced in. The dollar is priced for perfection here. We expect some dollar weakness. So it has been sharp and aggressive, like, don't get me wrong. But yeah, does this mean this is the end of the US dollar? I don't think so. Like, I mean, yes, central banks are diversifying their balance sheets. I mean, gold is rocketing. But I mean, will the dollar lose its reserve status just because it's devaluing? No. I mean, look at dollar devaluations since, over the last sort of 80 years. I mean, you lose just about everything. That's why cash is so terrible. It's called inflation. Like, that's why you buy things that protect you from inflation. That's why you make investments and you don't put all your money in your mattress. Okay, nice question. Why do you cash out every year? Will this not incur fees every time? Like I said, the whole product is after fees, and mainly it's so that we can reset the term. Because I think also resetting the 5-year term is important. We want those 9 chances to win to reset as often as possible. And like I said, I mean the return is pretty decent. And like I said, I suppose, would you want it to cash out every year? If you could put it within a wrapper where the client, so I'm just thinking of like a product question now, like if we could create a wrapper where the client wasn't feeling it at the retail level, would that be better? But the thing is the wrapper would generate extra fees. So yeah, it's a good question. Like I don't think it's not material. Like, in my mind,
I mean,
like I mean, you could lock people in for earlier, but it drops the number of chances that you can actually get out. So it makes the product, like, and there's a lot of guys that would, I mean, that's essentially just turns it into, I suppose, a coupon-based growth mode. We could give you one observation at 5 years and the coupon all the way through snowballed, but if that one observation, the market happens to crash, well, you're gonna be in trouble. Yeah.
Yeah, and also there's a benefit to being liquid as well. So in a year's time, you have another choice to make. You can decide to do you do this thing again, or think, hey, I found some new product that's going to be better for me, or whatever it is. The more liquid you are, the more options you have. And so yeah, the cash out every year is basically usually an advantage for people. They want to basically have the access to the money earlier and have the ability to choose again. Tying you down for a longer period of time. That's why when you have a fixed term deposit, they pay you more interest because it's a negative for you to be tied up for 6 years or whatever.
And it's not to say that we wouldn't. I mean, we do growth notes as well, where we do lock in for 5 years, and we build a payoff profile that does lock in for 5 years. We generally like, and it's another. I mean, we're getting great questions today. Like, I mean, we used to actually cycle. We used to kind of go autocall growth note, autocall growth note, which is kind of like the more exits and the single exit note. Those ones generally have participation on upside, and that's kind of how we were flipping between the two notes. And I can tell you the demand also came from our client base. We also respond to what people want. And the autocall has been way more popular among our client base. And it's like you kind of explain, because I mean, I'm still a big fan of growth notes.
Yeah.
And every time I kind of go pitch them, and then everyone's like, yeah, but we can't have any clients that want that. So
Yeah.
and I mean, I chat to my own clients and they're like, oh, but the lock-in period's so long. Like, yeah, so we honestly at this stage are just responding to client requests. But yeah, like I said, like what we were saying earlier in the presentation, if you have a specific requirement around a structured product, you just contact us and say, well, listen, I'm happy to lock it like this, and we lock it for you that way. So it's really, the beauty of these as well is that that we can tailor them. And I mean, this is kind of like quite a general product that we believe is applicable to a lot of different clients. So that's why we can do the lower entry point at $20,000. But kind of where the pricing, I mean, I didn't talk about the pricing here, but we can go and build it bespoke for you at $250,000. We can do one that is exactly the payoff terms that you want. We'll farm it out across probably 30 different banks. We actually run it through like 4 different quant shops as well, so that they can sharpen the pricing for us. So, I mean, we can get you to a very, very aggressive price. And then you can design it yourself as well. Like, that's also fine. So
just understand, okay, the one we do here will be like, larger and therefore a better deal. But 250,000 is like the minimum for the structure. But you go to 500,000 is a better thing to get. A million.
Yeah, there is an economy of scale. Yeah,
but a million is very top.
So it typically goes exactly 250, 500, a million. And like I said, like if we have 250,000 individually, like the same note here, you might get 11% on it, whereas we would get 12 and a half, 13 maybe. But that's just because of the economy of scale, because we're aggregating clients, and everyone, we've got a whole book of clients that are going into it. So you get that economy of scale as well, doing it individually. But like I said, if you've got specific terms that you really like, we'll also offer it to our clients as well and say, hey, we've got this client, they want it this way. We give it to a few other clients. If we can get you up to that $1 million level, then you'll benefit from the coupon as well, which is what we do. So we kind of
look. I mean, if you want something, you're not unlikely to be the one unicorn out that wants it.
So if you can you've got some really crazy Mongolian sheep structure, you might be the only guy. But if it's a reasonable structure that you're trying to achieve something that's sensible, and generally we find with our client base that is the case. I mean, often just engaging with our clients like generates amazing investment ideas as well. So it's kind of like one of the resources that we have, which I love. So if you do have something specific in mind, please get on.
Multiple clients have come to us, said, I have the base, and then we'll just go and add on to that, and then we'll get to the next level with other clients, but you can give the initial thing. So if you want to have a base thing, just give us a shout.
Do you think the dollar okay? Cash out will not include fees every time you cash out. Can you wrap the investments in an endowment? Yes, you can. Yeah, so we did chat about that earlier. I mean, we set up on all the major lists. So yeah, I mean, I think I'm not going to give you guys our preferred, but yeah, depending. I mean, again, just pop us an email. Whichever your preferred provider is. We've got contracts with just about everyone. So unless it's a really obscure list, as long as they've got an endowment and it can hold a PSB, you can hold this. No problem. 100%. All right. Thanks, guys. Lots of questions today, which I hope means that everyone was very engaged, and I hope you enjoyed it. And we will stick it up on YouTube as usual. And cool. thank you for listening
Thank you.
and enjoy the weekend.
Happy. Just make sure there's no other. Nothing in the chat.
Oh, was there chat stuff as well? Sorry, maybe we're not finished. No, there's nothing in the chat. All in the Q&A. Well done, guys.
Thank you.
All right. Thanks, everyone.
Cheers.
Cheers. Bye. Right.
Well, that was a long one.
Guys.
I thought Phil would be gone by the time.